Ask him about astrology. He will probably jump at the chance to come out of the closet and talk about the stars. Those who believe in perfect order in the markets accept that tops and bottoms can be predicted far into the future. Amateurs love forecasts, and mysticism provides a great marketing gimmick. It helps sell courses, trading systems, and newsletters. Mystics, random walk academics, and efficient market theorists have one trait in common. They are equally divorced from the reality of the markets. Extremists argue with one another, but they think alike. Support and resistance. A ball hits the floor and bounces. It drops after it hits the ceiling. Support and resistance are like a floor and a ceiling, with prices sandwiched between them. Understanding support and resistance is essential for understanding price trends and chart patterns. Rating their strength helps you decide whether the trend is likely to continue or to reverse. Support is a price level where buying is strong enough to interrupt or reverse a downtrend. When a downtrend hits support, it bounces like a diver who hits the bottom and pushes away from it. Support is represented on a chart by a horizontal or near-horizontal line connecting several bottoms. Resistance is a price level where selling is strong enough to interrupt or reverse an uptrend. When an uptrend hits resistance, it stops or tumbles down like a man who hits his head on a branch while climbing a tree. Resistance is represented on a chart by a horizontal or near-horizontal line connecting several tops. Minor support or resistance causes trends to pause, while major support or resistance causes them to reverse. Traders buy at support and sell at resistance, making their effectiveness a self-fulfilling prophecy. Support and resistance exist because people have memories. Our memories prompt us to buy and sell at certain levels. Buying and selling by crowds of traders creates support and resistance. If traders remember that prices have recently stopped falling and turned up from a certain level, they are likely to buy when prices approach that level again. If traders remember that an uptrend has recently reversed after rising to a certain peak, they tend to sell and go short when prices approach that level again. For example, all major rallies in the stock market from 1966 until 1982 ended whenever the Dow Jones Industrial Average rallied to 950 or 1050. The resistance was so strong that traders named it a graveyard in the sky. Once the bulls rammed the market through that level, it became a major support area. Support and resistance exist because masses of traders feel pain and regret. Traders who hold losing positions feel intense pain. Losers are determined to get out as soon as the market gives them another chance. Traders who missed an opportunity feel regret and also wait for the market to give them a second chance. Feelings of pain and regret are mild in trading ranges where swings are small and losers do not get hurt too badly. Breakouts from trading ranges create intense pain and regret. When the market stays flat for a while, traders get used to buying at the lower edge of the range and shorting at the upper edge. In uptrends, bears who sold short feel pain and bulls feel regret that they did not buy more. Both feel determined to buy if the market gives them a second chance. The pain of bears and regret of bulls make them ready to buy, creating support during reactions in an uptrend. Resistance is an area where bulls feel pain, bears feel regret, and both are ready to sell. When prices break down from a trading range, bulls who bought feel pain, feel trapped, and wait for a rally to let them get out even. Bears regret that they have not shorted more and wait for a rally to give them a second chance to sell short. Bulls' pain and bears' regret create resistance, a ceiling above the market in downtrends. The strength of support and resistance depends on the strength of feelings among masses of traders. A congestion area that has been hit by several trends is like a cratered battlefield. Its defenders have plenty of cover, and an attacking force is likely to slow down. The longer prices stay in a congestion zone, the stronger the emotional commitment of bulls and bears to that area. When prices approach that zone from above, it serves as support. When prices rally into it from below, it acts as resistance. A congestion area can reverse its role and serve as either support or resistance. The strength of every support or resistance zone depends on three factors: its length, its height, and the volume of trading that has taken place in it. You can visualize these factors as the length, the width, and the depth of a congestion zone. The longer a support or resistance area, its length of time or the number of hits it took, the stronger it is. Support and resistance, like good wine, become better with age. A 2-week trading range provides only minimal support or resistance. A 2-month range gives people time to become used to it and creates intermediate support or resistance, while a 2-year range becomes accepted as a standard of value and offers major support or resistance. As support and resistance levels grow old, they gradually become weaker. Losers keep washing out of the markets, replaced by newcomers who do not have the same emotional commitment to old price levels. People who lost money only recently remember full well what happened to them. They are probably still in the market, feeling pain and regret, trying to get even. People who made bad decisions several years ago are probably out of the markets, and their memories matter less. The strength of support and resistance increases each time that area is hit. When traders see that prices have reversed at a certain level, they tend to bet on a reversal the next time prices reach that level. The taller the support and resistance zone, the stronger it is. A tall congestion zone is like a tall fence around a property. A congestion zone whose height equals 1% of current market value, 4 points in the case of the S&P 500 at 400, provides only minor support or resistance. A congestion zone that is 3% tall provides intermediate support or resistance, and a congestion zone that is 7% tall or higher can grind down a major trend. The greater the volume of trading in a support and resistance zone, the stronger it is. High volume in a congestion area shows active involvement by traders, a sign of strong emotional commitment. Low volume shows that traders have little interest in transacting at that level, a sign of weak support or resistance. Trading rules. 1. Whenever the trend you are riding approaches support or resistance, tighten your protective stop. A protective stop is an order to sell below the market when you are long, or to cover shorts above the market when you are short. This stop protects you from getting badly hurt by an adverse market move. A trend reveals its health by how it acts when it hits support or resistance. If it is strong enough to penetrate that zone, it accelerates, and your tight stop is not touched. If a trend bounces away from support or resistance, it reveals its weakness. In that case, your tight stop salvages a good chunk of profits. 2. Support and resistance are more important on long-term charts than on short-term charts. Weekly charts are more important than dailies. A good trader keeps an eye on several time frames and defers to the longer one. If the weekly trend is sailing through a clear zone, the fact that the daily trend is hitting resistance is less important. When a weekly trend approaches support or resistance, you should be more inclined to act. 3. Support and resistance levels are useful for placing stop-loss and protect-profit orders. The bottom of a congestion area is the bottom line of support. If you buy and place your stop below that level, you give the uptrend plenty of room. More cautious traders buy after an upside breakout and place a stop in the middle of a congestion area. A true upside breakout should not be followed by a pullback into the range, just as a rocket is not supposed to sink back to its launching pad. Reverse this procedure in downtrends. Many traders avoid placing stops at round numbers. This superstition began with the off-the-cuff advice by Edwards and McGee to avoid placing stops at round numbers because everybody was placing them there. Now, if traders buy copper at 92, they place a stop at 89.75 rather than 90. When they sell a stock short at 76, they place a protective stop at 80.25 rather than 80. These days, there are fewer stops at round numbers than at fractional numbers. It is better to place your stops at logical levels, round or not. Markets spend more time in trading ranges than they do in trends. Most breakouts from trading ranges are false breakouts. They suck in trend followers just before prices return into the trading range. A false breakout is the bane of amateurs, but professional traders love them. Professionals expect prices to fluctuate without going very far most of the time. They wait until an upside breakout stops reaching new highs or a downside breakout stops making new lows. Then they pounce. They fade the breakout, trade against it, and place a protective stop at the latest extreme point. It is a very tight stop, and their risk is low, while there is a big profit potential from a pullback into the congestion zone. The risk-reward ratio is so good that professionals can afford to be wrong half the time and still come out ahead of the game. The best time to buy an upside breakout on a daily chart is when your analysis of the weekly chart suggests that a new uptrend is developing. True breakouts are confirmed by heavy volume, while false breakouts tend to have light volume. True breakouts are confirmed when technical indicators reach new extreme highs or lows in the direction of the trend, while false breakouts are often marked by divergences between prices and indicators. Traders try to profit from changes in prices. Buy low and sell high, or sell short high and cover low. Even a quick look at a chart reveals that markets spend most of their time in trading ranges. They spend less time in trends. A trend exists when prices keep rising or falling over time. In an uptrend, each rally reaches a higher high than the preceding rally, and each decline stops at a higher level than the preceding decline. In a downtrend, each decline falls to a lower low than the preceding decline, and each rally stops at a lower level than the preceding rally. In a trading range, most rallies stop at about the same high, and declines peter out at about the same low. A trader needs to identify trends and trading ranges. It is easier to trade during trends. It is harder to make money when prices are flat unless you write options, which requires a special skill. Trading in trends and in trading ranges calls for different tactics. When you go long in an uptrend or sell short in a downtrend, you have to give that trend the benefit of the doubt and not be shaken out easily. It pays to buckle your seatbelt and hang on for as long as the trend continues. When you trade in a trading range, you have to be nimble and close out your position at the slightest sign of a reversal. Another difference in trading tactics between trends and trading ranges is the handling of strength and weakness. You have to follow strength during trends, buy in uptrends, and sell short in downtrends. When prices are in a trading range, you have to do the opposite, buy weakness and sell strength. An uptrend emerges when bulls are stronger than bears, and their buying forces prices up. If bears manage to push prices down, bulls return in force, break the decline, and force prices to a new high. Downtrends occur when bears are stronger, and their selling pushes markets down. When a flurry of buying lifts prices, bears sell short into that rally, stop it, and send prices to new lows. When bulls and bears are equally strong or weak, prices stay in a trading range. When bulls manage to push prices up, bears sell short into that rally and prices fall. Bargain hunters step in and break the decline. Bears cover shorts, their buying fuels a minor rally, and the cycle repeats. A trading range is like a fight between two equally strong gangs. They push one another back and forth on a street corner, but neither can control the turf. A trend is like a fight where a stronger gang chases the weaker gang down the street. Every once in a while, the weaker gang stops and puts up a fight, but then is forced to turn and run again. Prices in trading ranges go nowhere, just as crowds spend most of their time in aimless milling. Markets spend more time in trading ranges than in trends because aimlessness is more common among people than purposeful action. When a crowd becomes agitated, it surges and creates a trend. Crowds do not stay excited for long. They go back to meandering. Professionals tend to give the benefit of the doubt to trading ranges. Identifying trends and trading ranges is one of the hardest tasks in technical analysis. It is easy to find them in the middle of a chart, but the closer you get to the right edge, the harder it gets. Trends and trading ranges clearly stand out on old charts. Experts show those charts at seminars and make it seem easy to catch trends. Trouble is, your broker does not allow you to trade in the middle of the chart. He says you must make your trading decisions at the hard right edge of the chart. The past is fixed and easy to analyze. The future is fluid and uncertain. By the time you identify a trend, a good chunk of it is gone. Nobody trades fast. When the market deviates from your analysis, you have to cut losses without fuss or emotions. When you identify an uptrend and decide to buy, you have to decide whether to buy immediately or wait for a dip. If you buy fast, you get in gear with the trend, but your stops are likely to be farther away and you risk more. If you wait for a dip, you will risk less, but will have four groups of competitors. Longs who want to add to their positions, shorts who want to get out even, traders who never bought, and traders who sold too early but are eager to buy. The waiting area for a pullback is very crowded. Markets are not known for their charity, and a deep pullback may well signal the beginning of a reversal. This reasoning also applies to downtrends. Waiting for pullbacks while a trend is gathering steam is an amateur's game. If the market is in a trading range and you are waiting for a breakout, you have to decide whether to buy in anticipation of a breakout, during a breakout, or on a pullback after a valid breakout. If you trade multiple positions, you can buy a third in anticipation, a third on a breakout, and a third on a pullback. Whatever method you use, there is one money management rule that will keep you out of the riskiest trades. The distance from the entry point to the level of a protective stop should never be more than 2% of your account equity. No matter how attractive a trade is, pass it up if it requires a wider stop. Money management tactics are different in trends and trading ranges. It pays to put on a smaller position in a trend, but use a wider stop. Then you will be less likely to get shaken out by reactions while you keep risk under control. You may put on a bigger position in a trading range, but use a tighter stop. Finding good entry points is extremely important in trading ranges. You have to be very precise because the profit potential is so limited. A trend is more forgiving of a sloppy entry as long as you trade in the direction of the trend. Old traders chuckle. Do not confuse brains with a bull market. When you cannot tell whether the market is in a trend or in a trading range, remember that professionals give the benefit of the doubt to trading ranges. If you are not sure, stand aside. Professionals love trading ranges because they can slide in and out of positions with little risk of being impaled on a trend. Since they pay low or no commissions and suffer little slippage, it is profitable for them to trade in gently fluctuating markets. Those of us who trade away from the floor are better off trying to catch trends. You can trade less frequently during trends, and your account suffers less from commissions and slippage. Most traders ignore the fact that markets usually are both in a trend and in a trading range at the same time. They pick one time frame, such as daily or hourly, and look for trades on daily charts. With their attention fixed on daily or hourly charts, trends from other time frames, such as weekly or 10-minute trends, keep sneaking up on them and wreaking havoc with their plans. Markets exist in several time frames simultaneously. They exist on a 10-minute chart, an hourly chart, a daily chart, a weekly chart, and any other chart. The market may look like a buy on a daily chart. Time frames of the same market often contradict one another. Which of them will you follow? When you are in doubt about a trend, step back and examine the charts at a time frame that is larger than the one you are trying to trade. This search for a greater perspective is one of the key principles of the triple-screen trading system. A losing trader often thinks he would be better off if he had a real-time quote machine on his desk. One of the universal fantasies of losers is that they would be winners if they could get their data faster and focused on a shorter time frame. But they lose money even faster with a quote system. When that happens, some losers say they would be better off trading right on the exchange floor without any delay for data transmission. But more than half of floor traders wash out in their first year. Being in the middle of the action does not do losers any good. The conflicting signals in different time frames of the same market are one of the great puzzles in market analysis. What looks like a trend on a daily chart may show up as a blip on a flat weekly chart. What looks like a flat trading range on a daily chart shows rich uptrends and downtrends on an hourly chart, and so on. When professionals are in doubt, they look at the big picture, but amateurs focus on the short-term charts. Trend lines. Charts reveal the actions of bulls and bears. Bottoms of declines show where bears stopped and bulls regained control of the market. Peaks of rallies show where bulls ran out of steam and bears gained control. A line connecting two nearby bottoms shows the lowest common denominator of bullish power. A line that connects two nearby tops shows the lowest common denominator of the power of bears. Those lines are called trend lines. Traders use them to identify trends. When prices rally, draw an uptrend line across the bottoms. When prices decline, draw a downtrend line across the tops. Projecting those lines into the future helps anticipate buying and selling points. The most important feature of a trend line is its angle. It identifies the dominant market force. When a trend line points up, it shows that bulls are in control. Then it pays to buy with a protective stop below the trend line. When a trend line points down, it shows that bears are in control. Then it pays to sell short and protect your position with a stop above the trend line. Most chartists draw a trend line through extreme high and low points, but it is better to draw it through the edges of congestion areas. Those edges show where the majority of traders have reversed direction. Technical analysis is poll-taking, and poll-takers want to track opinions of masses, not of a few extremists. Drawing trend lines through the edges of congestion areas is somewhat subjective. You have to watch out for the temptation to slant your ruler. Panic dumping by bulls at the bottoms and panic covering by bears at the tops create extremes, which appear as long tails on the charts. You want to base your trend lines on the edges of congestion areas and not on tails, because tails show little about the crowd other than its tendency to panic. The extreme points are very important, but not for drawing trend lines. Markets usually recoil from those tails, offering opportunities to short-term traders. A bar that looks like a finger sticking out of a tight chart pattern provides a valuable reference point for short-term traders. Markets constantly fluctuate, seeking an area that generates the highest volume of trading. A tail shows that a certain price has been rejected by the market. It usually leads to a swing in the opposite direction. As soon as you recognize a tail, trade against it. Place your protective stop halfway through the tail. If the market starts chewing its tail, it is time to get out. The single most important feature of a trend line is its slope. When a trend line slants up, bulls are in control, and it pays to look for buying opportunities. When a trend line slants down, bears are in control, and it pays to look for shorting opportunities. You can rate the importance of any trend line by examining 5 factors: the time frame of the trend line, its length, the number of times prices touch it, its angle, and volume. The longer the time frame, the more important the trend line. A trend line on a weekly chart identifies a more important trend than a daily trend line. A trend line on a daily chart identifies a more important trend than an hourly trend line, and so on. The longer the trend line, the more valid it is. A short trend line reflects mass behavior over a short period. A longer trend line reflects mass behavior over a longer time. The longer a trend continues, the greater its inertia. A major bull market may follow its trend line for several years. The more contacts between prices and trend line, the more valid that line. When the trend is up, a return to the trend line shows a rebellion among bears. When the trend is down, a rally to the trend line shows a rebellion by the bulls. When prices pull back to a trend line and then bounce away from it, you know that the dominant market group has beaten the rebels. A preliminary trend line is drawn across only 2 points. 3 points of contact make that line more valid. 4 or 5 points of contact show that the dominant market crowd is firmly in control. The angle between a trend line and the horizontal axis reflects the emotional intensity of the dominant market crowd. A steep trend line shows that the dominant crowd is moving rapidly. A relatively flat trend line shows that the dominant crowd is moving slowly. A shallow trend line is likely to last longer, like a turtle racing against a hare. It pays to measure the angle of every trend line and write it down on your chart. This can be done using a computer, a protractor, or a Chinese charting tool. Comparing angles of trend lines shows whether the dominant market crowd is becoming more bullish or bearish. It is uncanny how often trend lines trace the same angle time and again in a given market. It may be because the key players seldom change. Sometimes prices accelerate away from their trend line. Then you can draw a new, steeper trend line. It shows that a trend is speeding up, becoming unsustainable. When you draw a new, steeper trend line, tighten your stop, place it immediately below the latest trend line, and adjust that stop at every new bar. The breaking of a steep trend line is usually followed by a sharp reversal. When the trend is up, volume normally expands when prices rally and shrinks when they decline. This shows that rallies attract traders while declines leave them cold. The opposite occurs in downtrends. Volume expands on declines and shrinks on rallies. A pullback on heavy volume threatens a trend line because it shows that the rebellious crowd is growing. If volume expands when prices move in the direction of a trend line, it confirms that trend line. If volume shrinks when prices pull back to a trend line, it also confirms the trend line. If volume expands when prices return to a trend line, it warns of a potential break. If volume shrinks when prices pull away from a trend line, it warns that the trend line is in danger. The breaking of a well-established trend line shows that the dominant market crowd has lost its power. You have to be careful not to anticipate trading signals. Most traders lose money when they jump the gun. A trend line is not a glass floor under the market. One crack and it is gone. It is more like a fence that bulls or bears can lean on. They can even violate it a bit without toppling it, the way animals shake a fence. A trend line break is valid only if prices close on the other side of a trend line. Some traders insist that a trend line has to be penetrated by 2 or 3 percentage points of price. After a very steep uptrend is broken, prices often rally again, retest their old high, and touch their old uptrend line from below. When that happens, you have a near-perfect shorting opportunity. A combination of a double top, a pullback to an old trend line, and perhaps a bearish divergence from technical indicators. The reverse also applies to downtrends. The neglected essentials. Volume. Volume represents the activity of traders and investors. Each unit of volume in the market reflects the action of 2 persons. One trader sells a share and another buys a share, or one buys a contract and another sells a contract. Daily volume is the number of contracts or shares traded in one day. Traders usually plot volume as a histogram, vertical bars whose height reflects each day's volume. They usually draw it underneath prices. Changes in volume show how bulls and bears react to price swings. Changes in volume provide clues as to whether trends are likely to continue or to reverse. Some traders ignore volume. They think that prices already reflect all information known to the market. They say, "You get paid on price and not on volume." Professionals, on the other hand, know that analyzing volume can help them understand markets deeper and trade better. There are 3 ways to measure volume. 1. The actual number of shares or contracts traded. For example, the New York Stock Exchange reports volume this way. This is the most objective way of measuring volume. 2. The number of trades that took place. For example, the London Stock Exchange reports volume this way. This method is less objective because it does not distinguish between a 100-share trade and a 5,000-share trade. 3. Tick volume is the number of price changes during a selected time, such as 10 minutes or an hour. It is called tick volume because most changes equal 1 tick. Most futures exchanges in the United States do not report intraday volume, and day traders use tick volume as its proxy. Volume reflects the degree of financial and emotional involvement, as well as pain, of market participants. A trade begins with a financial commitment by 2 persons. The decision to buy or sell may be rational, but the act of buying or selling creates an emotional commitment in most people. Buyers and sellers crave to be right. They scream at the market, pray, or use lucky talismans. Volume reflects the degree of emotional involvement among traders. Each tick takes money away from losers and gives it to winners. When prices rise, longs make money and shorts lose. When prices fall, shorts gain and longs lose. Winners feel happy and elated, while losers feel depressed and angry. Whenever prices move, about half the traders are hurting. When prices rise, bears are in pain, and when prices fall, bulls suffer. The greater the increase in volume, the more pain in the market. You can lose a great deal of money in a sleepy market, such as corn, where a 1-cent move costs only $50. If corn goes against you just a few cents a day, the pain is easy to tolerate. If you hang on, those pennies can add up to thousands of dollars in losses. Sharp moves, on the other hand, make losers cut their losses in a panic. Once weak hands get shaken out, the market is ready to reverse. Trends can last for a long time on moderate volume, but can expire after a burst of volume. Who buys from a trader who sells his losing long position? It may be a short seller taking profits and covering shorts. It may be a bargain hunter who steps in because prices are too low. That bottom picker assumes the position of a loser who washed out, and he either catches the bottom or becomes the new loser. Who sells to a trader who buys to cover his losing short position? It may be a savvy investor who takes profits on his long position. It also may be a top picker who sells short because he thinks that prices are too high. He assumes the position of a loser who covered his shorts, and only the future will tell whether he is right or wrong. When shorts give up during a rally, they buy to cover and push the market higher. Prices rise, flush out even more shorts, and the rally feeds on itself. When longs give up during a decline, they sell and push the market lower. Falling prices flush out even more longs, and the decline feeds on itself. Losers who give up propel trends. A trend that moves on steady volume is likely to continue. Steady volume shows that new losers replace those who wash out. Trends need a fresh supply of losers, the way builders of the ancient pyramids needed a fresh supply of slaves. Falling volume shows that the supply of losers is running low, and a trend is ready to reverse. It happens after enough losers catch on to how wrong they are. Old losers keep bailing out, but fewer new losers come in. Falling volume gives a sign that the trend is about to reverse. A burst of extremely high volume also gives a signal that a trend is nearing its end. It shows that masses of losers are bailing out. You can probably recall holding a losing trade longer than you should have. Once the pain becomes intolerable and you get out, the trend reverses.